Welcome to Trading Nation, folks. I'm Eric Chemi. Today we're joined by Mandy Xu. She's equity derivative strategist at Credit Suisse. Mandy, thanks for being here.
Thanks for having me on.
Of course, you've got a new note out saying volatility has normalized across different asset classes. But why do you think there's still a nervousness in the market?
Yeah, I think, if you look at what's been going on in the vol markets, first of all, vols are obviously down compared to the highs we saw last month. But really, what's driving that normalization is really in the short-dated maturity, meaning near-term concerns have very much abated. But what we're seeing in the longer-dated part of the curve, so if you look at options with 3-month or 6-month maturity, volatility for those options have come in or normalized a lot slower compared to, for example, 1-month option versus the VIX. So what that tells me is, the source of risk or concern that the market is focused on has very much shifted away from kind of being the more positioning or technicals-driven move we saw last month to more fundamentals, right? Over the next 3 to 6 months, there's more focus on monetary policy, what's going on there, with fiscal policy, with risks to trade, to geopolitical risks. So I would say, volatility is normalized, but it's investors are still pricing in risk longer out in the curve.
So there's so many people that talk about how vol goes up when markets sell off, and that if you just look at vol, you're really just looking at whether the market's going up or down. So how much of the vol number for kind of, let's call it a rookie vol watcher, how much of this can just fool them into just simply, well, the vol goes up when the markets go down and vice versa, versus trying to pull out some extra information that's in there beyond direction?
Yeah, absolutely. So, everyone kind of looked to the VIX as a benchmark for volatility, but, keep in mind the VIX is really just a measure of 1-month vol, and it very much, moves the opposite way of the S&P, like you just alluded to. So, we like to look at in terms of measure, for example, skew, which we think is a very better measure of investor sentiment. It looks at demand for puts versus calls. And what was interesting last month during the dislocation in the VIX that we saw was that the move in skew was very much contained. So we did not see kind of the panic buying of protection that would be implied by just looking at the VIX. Other measures that we look at, for example, correlation, which tells you how much of the risk is macro versus fundamental. And what we're seeing there is that a normalization in correlation in the correlation market much faster in the VIX market, telling you that going forward, investors are much more focused on fundamental risk rather than macro. So, these other measures, I think, give you a better sense of what's being priced in terms of risk than just looking at the VIX.
That's a good point. So then what is someone to do, a trader at home watching this right now, and he's thinking, all right, well, I see the VIX a lot, but I don't see a lot of good metrics for correlation. I don't see some of these other metrics on a day-to-day basis getting discussed on CNBC. So how do they get some of that information? What are maybe 3 benchmarks of indices that they should be tracking that helps give them a fuller picture?
Yeah, so I think, for correlation, it is definitely harder to track. SIBO has a couple of correlation indices, ICJ, KCJ, and JCJ. And of course, we at Credit Suisse keep our own measure for correlation. And that's kind of, we think a key metric for investors to look at in terms of, is it more macro driven, is it more fundamentals, what's going on with sector dispersion. These factors obviously drive alpha and drive return much more so than, the level of the VIX.
Is there any particular sector that stands out to you right now in terms of what the volatility of that sector might be saying?
So not so much, sector within the U.S., but I think what's interesting right now that we're seeing is a divergence in risk that's being priced in for the S&P or U.S. equities compared to emerging market equities, so EEM, for example.
Okay.
So what we're noticing is that even though skew, so that measure I talked about, demand for protection, is pretty muted in the U.S., we're seeing it at much more elevated levels for emerging market equities, especially for short-dated options. So what that tells me is that, all the headlines about trade, people haven't really started pricing in that risk for U.S. equities, but they have for emerging markets, for countries like China and Mexico, who are obviously the most vulnerable to any escalation in trade tensions.
And then finally, we had a chart up earlier that showed the VIX, basically call it at 10, and then one day it goes to 40. I mean, when something like that happens effectively overnight, what are you telling your clients? What are you telling your traders? How do you manage something like that that effectively nobody saw coming 24, 48 hours in advance? What if that happens again, let's say tomorrow? I mean, there's no predicting this.
Right. So, it's funny. So, obviously, no one could have predicted when this, explosion in the VIX was going to happen. But the vol market was telling you something like this could happen. So, one measure that we keep track of is called vol, and you can follow it. It's a VVIX index.
Wait,
and
so
what we've been
of vol. So it's the volatility of volatility. Okay.
The volatility of the VIX.
Okay.
You can think about it like that. So, what we've been highlighting going into year end and the start of this year was that even though VIX was trading at record lows, vol was actually trading at very elevated levels compared to vol. And what that divergence was telling you was that the VIX, there's this explosive potential to the VIX, right? So when the VIX goes from 10 to 40, it's not going to happen over the course of weeks. It's going to happen over the course of a day. And that's exactly what we saw in February. On the more reassuring side, right now that market, vol, has come in quite a bit. So right now that market at least is not signaling a recurrence, a repeat of what we saw in February.
Okay. Good stuff, Mandy. I appreciate it. Thanks for coming on here.
Yeah, great to have you. Great to be here.
Of course. My thanks to Mandy Xu of Credit Suisse for joining us today. And thank you for watching Trading Nation. I'm Eric Chemi. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.